What the banks don't tell you about money and how the system really works. In our first video, we learned about how banks create money. They do this by making loans and creating debt. We also learned that when a bank makes a loan, it doesn't create the money to lend out of thin air. Instead, it creates the money by first borrowing it from another bank and then lending it out to you, the borrower. The borrower then pays back the loan plus interest. The bank keeps the interest and uses it to pay back its own debt and to make a profit. Aside from the government, banks are the second largest creators of money in our economy. This is because when you deposit money into a bank, they are only required to hold onto a small percentage of that money, known as the reserve requirement, while they can lend out the rest. This process of lending out money that doesn't belong to them is called fractional reserve banking, and it's how banks make a profit. This is Capitalist Domain, and in this video, we're going to take a closer look at how this system really works and what the banks don't tell you about money. You're probably asking now, what does all of this have to do with me? Well, if you're like most people, you probably have a savings account and maybe even a checking account at the bank. And every time you make a deposit, the bank is able to lend out a portion of that money and charge interest on it. Not only do banks profit from the interest they charge on loans, but they also profit from the interest you earn on your savings. In fact, this is how most banks make the majority of their money. The banking system is actually designed to make the rich richer and the poor poorer. It's a system that's rigged against you, and it's important to understand how it works so that you can protect yourself. The first thing you need to know is that banks don't always have your best interests at heart. They're in business to make money, and they do that by lending money and collecting interest on those loans. They're not interested in helping you save money or get out of debt. In fact, they want you to stay in debt so that they can keep making money off of you. Here's an example. Let's say you have a credit card with a $5,000 limit. The bank knows you can't afford to pay off the entire balance, so they're counting on you to make minimum payments each month. They're also charging you interest on that balance. So the longer it takes you to pay off your debt, the more money the bank makes. The same is true for mortgages and student loans. The longer it takes you to pay off your loan, the more money the bank makes in interest payments. That's why banks will often give you a lower interest rate if you agree to a longer repayment period. They know that they'll make more money in the long run if you take longer to pay off your debt. So when you're dealing with banks, always remember that they are not your friend. You need to be smart about how you use your money so that you don't end up giving all of your hard-earned cash to the banks. The second thing the banks don't tell you about money is that the interest rates they charge are often completely arbitrary. They can charge whatever interest rate they want, and they're not required to justify it. In fact, banks have been known to raise interest rates without any notice at all. Keep in mind that interest rates are one of the biggest ways banks make money. The higher the interest rate, the more money they make. So if you're carrying a balance on your credit cards or loans, the banks are probably making a lot of money from you. For instance, let's say you have a credit card with $5,000 balance and an interest rate of 18%. If you only make the minimum payment each month, it will take you nearly 30 years to pay off your debt. And during that time, you will have paid more than $12,000 in interest payments. That is money that could have been used to buy a car or save for retirement. But instead, it's going straight into the bank's pocket. The next thing you need to know about how the banking system works is that they use your deposits to make loans to other people. When you deposit money into a bank account, the bank doesn't just sit on that money. It uses the money to make loans to other people, and those people then pay back the loan with interest. So when you deposit money into a bank, you're actually helping the bank make more money. Let's dig into this deeper. When you make a deposit into a bank, the bank is required to hold onto a certain percentage of that money. This is called the reserve requirement, and the rest of the money the bank can lend out. So if you deposit $100 into a bank and the reserve requirement is 10%, the bank has to keep the $10 in the account. The other $90 the bank can lend out. The borrower then pays back the loan with interest. Let's say the interest rate is 5%. So if they borrow $90 from the bank, they have to pay back $95. The $5 goes to the bank as profit. Now let's say you have $1,000 in your bank account. The reserve requirement is 10%. So the bank has to keep $100 in the account. The other $900 the bank can lend out. The borrower then pays back the loan with interest. Let's say the interest rate is 5%, so if they borrow $900 from the bank, they have to pay back $950. The $50 goes to the bank as profit. So when you make a deposit into a bank, you're actually helping the bank make money. The banks then use that money to make loans to other people and charge them interest on those loans. And that's how they make their profits. What you also need to understand about banks is that your savings account isn't really safe. In fact, it's one of the riskiest places to keep your money. This is because when you deposit money into a bank, they don't have to keep all of it in the vault. They can lend out a portion of it and charge interest on those loans. This means that if the bank goes bankrupt, you could lose some or all of your savings. That's why it's important to diversify and not keep all your eggs in one basket. But how do you know if a bank is safe? Well, the best way to protect yourself is to spread your money around. Don't keep all your money in one bank, and don't keep all your money in cash. Consider investing in other assets such as stocks, bonds, and real estate. Diversification is key when it comes to protecting your money. By spreading your money around, you can minimize your risk and maximize your potential for growth. Remember, the banking system is complex, but by understanding how it works, you can make sure that your money works for you instead of against you. The last thing you need to know about banks is that they're not really in the business of loaning money. In fact, loans are the very small part of their business. The vast majority of their profits comes from fees. Fees for things like overdrafts, monthly maintenance, and even ATM withdrawals. These fees can add up quickly, and they all go straight into the bank's pocket. Always remember that the best way to avoid these fees is to be aware of them and to shop around for the best deal. For example, if you have a credit card, the bank charges you an annual fee just for having the card. They also charge you fees for things like late payments, over-the-limit charges, and cash advances. And if you have a savings account, the bank probably charges you monthly maintenance fees as well. Fees are a much more reliable source of income for banks than loans. And that's why they're always looking for new ways to charge you fees. It's crazy, but it's the truth. So the next time you're thinking about opening a bank account, make sure you understand all the fees involved. Otherwise, you can end up paying more than you ever thought possible. The power is actually in your hands. You can choose to keep your money in a bank or to invest it elsewhere. And if you're thinking about taking out a loan, remember that banks are in the business of making money, not loaning it. Banks are everywhere, and they want to know every detail about you. The banks can see when you're making purchases or taking out loans. This information provides them with a wealth of knowledge that could be used against people in the future if their data gets hacked. You're a walking target, and the banks know it. They make your life difficult when you try to save money by making you jump through hoops. They make it nearly impossible to get out of debt. And they use every trick in the book to try and get you to spend more money. The thing is, we don't have any say over whether our bank shares personal details like this. And who would trust someone anyway? But there's an easy way around it. Just refuse giving consent for any kind of digital tracking procedures while signing up at all. No matter how small, it makes a difference in the long run. Banks are essential for our economy to function, but we need to be aware of how they make their money. We also need to be careful about how much information we give them. By understanding these things, we can protect ourselves and our finances. It's no wonder why most people are broke by the age of 30. The banks have designed the system to keep you in debt and under their control. But you don't have to play by their rules. With a little knowledge and effort, you can take control of your money and your life. And that's it for today's video. We hope this has helped you understand how the banking system really works. Now that you know several things the bank don't tell you about money, you can be a smarter and more informed customer. So be sure to use this information for your advantage. If you have any questions or suggestions, please leave them in the comments below. And if you enjoyed watching this video, consider giving it a thumbs up and subscribe to Capitalist Domain for more informative contents like this one.